After another week that would give anyone a whiplash, one that saw inflation pick up and dogs run around without leashes, and as we approach a week filled with more volatility, many are coming from far and from wide asking just what are the top 3 stocks for this week. But first, of course, we must give an update on some plays from last week and what's going on. Okay, so we've continued to see some of the biggest names in tech get punished and pummeled, and Baba Go Sheepa Baba was a big example of that, with Baba reporting increasing revenue and bullishness around leaving the Chinese scrutiny, but continues to accelerate downward. Everything tech-centric has been punished by the inflation trade, and of course the temporary sinking tech tide is lowering all ships. Capital just hasn't wanted to flow into tech, and with that, I'm prepared to be wrong until tech comes back. I'm prepared to say, hey, it's better to get good deals on tech when it's down than to wait until it's already back up at all-time highs. Obviously, one of the issues with the biggest euphoric periods is they create a lot of traders who just have this need for instant gratification when it comes to some of these longer-term plays. But the irony is that when you have a longer-term play, you don't need that instant gratification in the short term. In fact, it could actually really hurt you in the short term. Pick any stock in the stock market that's done well over the last 20 years, and odds are strong that it went through at least 4 or 5 different cycles where people just thought it was the worst stock, and then other cycles where people just thought, this is the best stock, I can't believe no one bought it, and then, just cycles back and forth. And I think that as traders, you have to have that bigger perspective, because if you're just stuck in like the day by day with a longer term play, you're just doing yourself a disservice. Okay, on to the next thing. We saw a lot of short squeezes last week, especially on Friday. Gevo popping up 24%. This was also after their earnings. We also saw BNGO pop up after its earnings, up nearly 23% on Friday. Mara and Riot up around 17% on Friday. But keep in mind, right now we're still in a downward direction. We need to see more evidence of a reversal. So that means you either trade them short term or you just hold out for the long run. Mara and Riot are specifically set up for a very rough week as Bitcoin has broken to 45 for the first time in a while. Mara and Riot mine Bitcoin, and they've been bludgeoned on the fact that Bitcoin has been a little bit cooler. And of course, on the interest rate side, seeing Bitcoin break into some new recent lows is really freaky if you're looking at Mara and Riot. We're definitely on the verge of what could be a very big crypto storm, so you should see some volatility in Mara and Riot to say the least. And of course, new Elon Musk backtracks aren't helping either. At the end of the day, what this really goes to show you is that you should buy something because you believe in it, not just because Elon or myself or your neighbor Susan like it, because at the end of the day, you're going to deal with these conviction crises if you don't do that work yourself. Everything has down cycles, so if you're not building that conviction yourself, you're going to be open to panics every single time something like this happens. It's also true that a lot of catalysts continue to get eaten up, but that's good to see. For example, FSR finalized a deal with Foxconn to make EVs in the US starting in 2023, and this was a big deal. And it caused a massive rally almost immediately, and then completely obliterated it later on. I understand that when stocks sell off, you create a lot of perma bears. Maybe some bears come out of the woodworks, or some bulls now become long-term bears. But keep in mind, though, that when you have companies that report good catalysts, you do have to ask yourself, does a good catalyst, does that add or subtract value to a stock? We've seen numerous companies report great catalysts or earnings beats, and if they rally, the rally gets almost immediately sold. And that's just a function of the market we're in right now. But what I see is a lot of people are like, well, there's no such thing as a good catalyst for a growth company. Every growth company is too valued in the sense that it has value at all. Obviously, the flip side was that back in January and February, people were like, there was no top to this. It's just the same mindset in reverse. When things are going up, people push it too high, and then when things are going down, people push it too low. I guarantee you there's a lot of people who are like, there is no price that I would pay for a growth stock, even if it was at 1 cent. It's too overvalued. If Tesla was trading at $10 a share, like, why would you pay that? They have competition issues. Truth be told, if you're a bull of good companies, you got to be prepared to be really wrong during certain sections of time. But over the long run, if you have good companies, the perma bears just tend to disappear. I don't know why that happens, but it's happened a few different times on the channel. You have like all these people who are like, no, you shouldn't talk about Tesla. You shouldn't talk about NIO. You shouldn't talk about all these. And then, after the sell-off, it starts going up and they kind of disappear. They don't come back again until it sells off again. But at the end of the day, if you have a long-term play, what I'm saying is you gotta stick to the process. You're gonna see much worse in the future. I don't necessarily mean the immediate future, but over the years, if you're in the stock market for 5, 10, 15 years, trading, long-term plays, short-term plays, whatever, you're going to see so many periods that are much worse than this and much better than this. So it's just kind of like training, you're training for the future. I can't tell you how many people quit the stock market forever during that COVID crash of last year. There's no doubt that a lot of people are going to quit this time too, but at the end of the day, this is just what we're used to. We got to keep doing it over and over again and just keep showing up. In terms of day traders, UVXY and SVXY continue to provide a lot of opportunities, with UVXY rallying towards the beginning of the week and its inverse SVXY rallying towards the end of the week. This is a very powerful pair because it allows you to be direction independent. A lot of people will say like, oh, I know that the stock market's going to sell off for the next 6 months, or I know that the stock market is going to go up for the next 6 months. But at the end of the day, having some exposure to these direction independent funds can be very, very powerful because it doesn't really matter which way the market goes. You could trade it intraday and trade off that direction. UVXY and SVXY is the fear index, so you're trading off fear, but the same idea goes. In terms of gold opportunities, JNUG and JDST are also providing a lot of moves. The other thing I wanted to talk about very quickly was AMC, which was a short-term play that we introduced a couple weeks ago. We were like 3-4 days early on this one, but this was a play that we listed out as a potential short squeeze candidate about 2 weeks ago to watch around earnings. Earnings took AMC from the bottom at $8.93 to $14.34 within just a few days. Now, if you're somebody that's a buy and hold trader, every growth stock and every long-term conviction play has been punished consistently week after week because of the rotation. But if you're a short-term trader, you continue to see some of these little opportunities pop up. There's definitely opportunities out there. You just got to be diligent to find them, research them, and then have very concrete entry and exit plan. With AMC, we talked about how we looked at the short data, the social sentiment boosts that were trending back to it, and we saw earnings as a catalyst to really accelerate that trend, and that did happen. Do I think that AMC is going to maintain itself? Well, it's unlikely. A lot of these short-term plays don't reward long-term holders. They reward short-term traders. If you're a long-term holder of any stock that has a lot of value to it, I don't know if that's AMC particularly, but if you're a long-term holder, you got to be patient and you got to wait until the market cycles back. Okay, folks, now it's time that we talk about our top 3 stocks for this week, and the only thing I ask of you in return is that you hit that ravishing like button, and also don't forget to subscribe either. Also, this video is sponsored by ZipTrader U. If you'd like to learn how to trade with our step-by-step video lessons, our private chat, and of course our daily morning briefings where we brief on each and every catalyst in the pre-market every single day about 30 minutes prior to market open, well, I'll go ahead and put a link to ZipTrader U below. Go ahead and click the link and then watch the intro video where this handsome gentleman will talk about everything the program has. That way you can kind of get yourself familiar with what we offer and see whether or not we're a good fit. Truth be told, this is a program that you got to watch each lesson and take your time with and really put the work in order to see any sort of progress. But if you are ready to take the leap, I'll go ahead and put coupon code Battlefield75 in the description. It'll get you $75 off. Okay, first stock is Discovery. So you may remember that Discovery got beat down as part of the Archegos fund meltdown back in March. From heights, the company's stock is trading more than halfway down. And in the last week, we've seen some repositioning of big money into some of these big plays, Discovery being one of those. And of course, when you see big money buying, you're like, hey, they know something. Today, it just announced that AT&T is exploring a merger with Discovery, aka they are in talks. We'll likely find out tomorrow or the next day whether this is true, but this is a big deal for Discovery if it goes through. This would mean a huge windfall for Discovery, and it will also help AT&T a lot because they're trying to expand their media arm. AT&T is trying to build out a platform that will make it competitive with the likes of Netflix. AT&T has built up an ecosystem of many major stations under Warner Media, from HBO, CNN, TBS, TNT, and the likes, many of which you've heard of. But adding Discover would add a whole slew of new content and subscribers to the ecosystem. AT&T has done this before. A similar acquisition was done in 2018 where AT&T bought Time Warner, which it bought for $85 billion. In comparison, Discovery is a fairly small fish to catch at just under $17 billion in market cap, and it would make a lot of sense for them to merge with them. And on the Discovery side, Discovery has been investing in streaming and going next gen for the last couple of years. And they have done pretty well with that, but the addition of Discovery into the AT&T ecosystem, that would provide a lot more resources and talent for Discovery to ensure their success. Truth be told, traditional cable networks were dying before they went the streaming next-gen route that the likes of Netflix took. Industry was basically bent over as Netflix went in with their originals, and so wealthy telecommunication companies like AT&T have been building up a portfolio to beat them or at least compete with them. And chart speaking, this is an interesting setup to bring a catalyst into. I mean, if you wanted to play it short term, you could just set a stop loss at just under the previous support level and play the opportunity, but also cut out quickly if you're wrong. Okay, next, Baidu. So one of the things that I look for are stocks that have made consistent bottoms and held there. If buyers and sellers met at one location multiple times, that means that if you have one strong catalyst that pushes that in one direction or the other, you could see a squeeze. And Baidu is a prime example of this. Baidu is one of the biggest search engines in the world, sort of like the Chinese competitor to Google, and it has over 202 million active daily users. This is also a stock that Wall Street analysts happen to like quite a lot, which that's very rare. The average of 16 major analysts reported their price target at 351. Even the bearish analysts that hate everything Chinese and hate everything tech put their price targets at 280, which is still substantially higher than the current price. And the reason for this is actually quite simple. The reason that their price targets are high is because Baidu has reported better and better and better earnings quarter over quarter. They keep consistently beating Wall Street's expectations, and when you keep beating Wall Street's expectations, they give you a high price target. Of course, the stock market isn't really rewarding companies right now. It's punishing companies because of interest rate scares. And this was also one of the ones that was a victim of the Archegos family office crash, margin call dilemma. But keep in mind, eventually there's going to be a very, very strong come-to-truth moment for a lot of these companies that keep reporting great numbers, but just keep getting beat down as a result. And this Tuesday, Baidu will be reporting earnings, so this could be the first come-to-truth moment. We'll get a peek into if they continue their trend of beating expectations quarter over quarter, and I wouldn't be surprised to see some opportunities around that. In terms of inflation plays, you know that credit card companies are some of my favorite, and we just got an opportunity in MasterCard, with MasterCard looking the most oversold right now. Credit card companies are, of course, set to explode as economic activity explodes towards the summer, and with MasterCard trading down at this oversold level, I'm a fan. Obviously, right now, a lot of people agree that credit card companies are a good deal, and you have a lot of these other big inflation trades that people are like, oh, those are a great deal. Everybody's going to start hating them once they have that cycle down. It's just the way that the market works. So if you're going to buy something when it's relatively higher up, then you got to make sure you have that high conviction, or else you're just going to sell out when it's at the lows and then cycle into whatever is the winning trade of that time era. So something to think about, folks. Anyways, that's all for today. If you have any questions, feel free to reach out to us below. If you'd like to join us in ZipTrader U, I'll put a link below. If you'd like some free stocks with Webull, I'll go ahead and put a link below as well. And that caps off the video. Have a good one, and I'll see you in the next one.